If you're willing to buy on the way up, why wouldn't you still be willing to buy now on the way down when the stock is now cheaper? This makes no sense.
This is a very complex process that, even with all of our research, we do not completely and fully understand. However, it seems to me that with this complex of a process, there is going to be some wrinkles as you ramp up. Months like July, or specifically last week, last Friday, with significant pullbacks, definitely play on our emotions. Nick and I are long term investors, and we know many of our viewers are as well, but it still can hurt to look at your portfolio taking such a hit as it has. And it's Monday, August 5th, and it looks like it's going to be the start of another rough week. So, we're going to talk about some of the factors that came into play in the last month that are drawing down the market and how you should view this as an investor, as a long-term investor.
Yeah, and I know everybody wants to know about Nvidia. It's been a bit since we've talked about Nvidia specifically. And here pre-market Monday morning, it looks like we're under $97 a share. We put this slide deck together over the weekend. So this chart isn't reflecting another roughly 10% decline pre-market Monday morning. But when you add that in, Nvidia stock is now 40% down from its peak just a mere couple of months ago. But if you zoom out back to the start of 2023, we've been talking about this a lot with our semi insider members over on Discord. This is just statistics. It's been an epic run since the beginning of 2023, or specifically maybe the fourth quarter of 2022 for Nvidia stock, up several 100%. And whenever you have a stock run up this much and you get these premium valuations on businesses like this, it's just inevitable that some really extreme volatility is going to hit. So as painful as this has been, and it looks like we're not going to be done with it yet, as bad as this has been, this is still in our minds a normal and healthy market action. And we're going to explain, like you said, Kasey, some of the things that has triggered the sell-off, because unfortunately we can chalk this up to statistics, but really this is just how markets work. It's just statistics. We don't have to pin a reason on every market sell-off or downturn. The start of this bull market has been driven almost completely by large cap tech. Invesco QQQ, which is a measure of the NASDAQ 100 index, up 70% since the start of 2023. And Kasey, it's been a pretty big divergence from some other leading market indices, right?
Yes, absolutely. Two other ETFs, Spider, SPY, S&P 500 ETF, up nearly 40% since the start of 2023. And then the iShares Russell 2000 ETF, that is the basket of 2000 small cap stocks, up only 20% since the start of 2023. And we recently had a video about small cap stocks in the midst of the Fed interest rate hikes. We'll link that right here. Make sure you check that out, because that is definitely going to come into play, as the Fed has said that they're actually going to start cutting those interest rates. So ultimately, large cap companies having much more growth over the last couple of years, small cap companies overall, some growth, but not nearly at the same pace.
Yeah, absolutely. And large cap tech in particular, vastly outperforming things. So up to this point, let's call it a year and a half, coming up on 2 years of a new bull market, it hasn't been a healthy bull market. And so the market is suddenly pulling back some capital, pulling some profits off the table because we're unhappy with the Fed cutting rates. These are unusual times. The Fed has artificially kept interest rates higher than they should be for 2 years now to try to fight inflation, even though the vast number of economic studies out there have explained that most of the inflation actually came from supply chain disruptions. And it just takes time to iron those wrinkles out. So the market is suddenly concerned that the Fed not cutting rates in July, instead kind of teeing up a rate cut in September, could run the risk of them triggering a recession. You could argue that we've been in a recession all along, that some of the metrics, some of the data metrics that measure an official recession are just simply broken, that they're not really that relevant anymore. I think I, at least personally, kind of lean that direction. We've never really fully emerged from the bear market yet. It's just the semiconductor industry has kind of led the charge out of the very beginnings of a new economic growth cycle. But long story short, there's a ton of uncertainty here and a confluence of events. It's an election year, not just in the US, but in a lot of countries around the world. Election year, that causes volatility. The Fed, it looks like maybe flat-footed again, not new information. We've known this for quite some time. And then some tech companies, stubbornly, at least in Wall Street's pea brain, spending too much money on capital expenditures, on AI infrastructure, even though it's not AI infrastructure, it's just cloud computing infrastructure, accelerated computing. We debunked that for you already. Check that video out. Confluence of events, no new real data, but a confluence of events kind of getting the spotlight. Of course, the media doing its thing to hype this whole thing, causing the market to pull back a bit. We're just going to call it statistical randomness. It happens, especially when you kind of stretch a long run of stock returns with very little volatility along the way. It just increases the probability that sooner or later you're going to get a healthy pullback. It feels unhealthy, but it's probably just a healthy pullback.
I think this is probably a good time to bring in a little bit of Olympic coverage to our discussion. We've had some fun watching some of the Olympics, and we have definitely enjoyed even more the memes that have come out of the Olympics.
Yeah, and this one in particular, I think, aptly describes how some are trying to decipher what's going on right now with the market on the top, when really most investors could settle for silver by keeping things pretty simple, like on the bottom.
Just come out, aim, fire, hand in the pocket. In addition to our Olympics coverage, we've also been using a new app that we wanted to share with everyone. And that app is from Moomoo. Earnings season is here, but it really doesn't matter because the market has been crashing. However, Moomoo is looking to make up some of those losses with up to 20 free stocks.
That's right. New users in the US that open a Moomoo account before the end of August and deposit $1,000 get those 20 free stocks. That's a chip stock investor exclusive offer. And in addition to that, any uninvested cash you have in your Moomoo account earns a bonus 8.1% APY for the first 3 months during this current market downturn. We're going to get into this here briefly in a few minutes, Kasey, but the importance of getting data directly from the businesses you invest in. Moomoo can help with that.
In addition to setting your calendar for earnings season with Moomoo, you can set notifications for earnings, track your favorite stocks, see how things are going, and save and revisit the latest earnings calls and financial results later so you can analyze the data on your own to make the best portfolio decisions for you. Moomoo also offers 0% commission on stock, options, and ETFs. There's no minimum deposit requirements, no account management fees, and no hidden costs.
And again, don't forget about that special offer. Up to 20 free stocks if you deposit up to $1,000 in your Moomoo account, the 8.1% APY on your uninvested cash for the first 3 months. And one more thing, you also get a transfer in bonus of 1.5% cash back if you move an existing brokerage account over to Moomoo, valued at up to $300 cash bonus. All of these rewards can be earned together. Don't miss out on this exclusive chip stock investor offer from Moomoo through August 31st, 2024. If you're a new user, sign up for an account today. Circle this back to Nvidia and what we should expect headed into their Q2 report, which is about 3.5 weeks away now.
Yes, we should. There has been some discussion in our community, and we know in other investment communities as well, about a so-called breaking news report from a media company, The Information. This report states that Blackwell is going to be delayed and that Nvidia had to tell the big tech giants like Google, Microsoft, Meta that they're going to have to wait on those Blackwell shipments. We know that this rumor is definitely playing into what's happening with the stock price of Nvidia. The stock's decrease in the recent days. Here's what we actually know. In Q1 fiscal year 2025, the last quarter that Nvidia reported, total revenue was 26 billion, most of that data center. The guidance for this upcoming quarter, revenue is expected to be $28 billion. So an increase, plus or minus 2%.
Yeah, and this is already a slower sequential increase that's expected than recent quarters. I'll back up to the last slide again that you were just talking about, Kasey. On the bottommost row, you can see something like $4 to $5 billion sequential increase ever since last year, the start of fiscal year 2024, which mostly corresponds to calendar year 2023. So we already knew that the pace of NVIDIA's sequential revenue increases were slowing. Okay. This was already data that we had from the company. The reason for this is because Blackwell, which goes into that data center segment, was going to begin ramping up production the second half of this year. Ramping up production doesn't mean all out growth because of Blackwell yet. We can link some of our past videos on this from earlier this year after NVIDIA GTC in March to explain more of this. But Blackwell it's not a chip. It's not a GPU. It's an accelerated computing system. And these things are unlike anything we've ever seen before in the data center. The power consumption of these things is through the roof. The amount of computing power is off the charts. And to pull it off, NVIDIA's primary manufacturing partner, Taiwan Semi Manufacturing, is not just ramping up production of these things, but we're using a new manufacturing process as well.
You and I certainly do not claim to be engineers of these semiconductors. This is a very complex process that, even with all of our research, we do not completely and fully understand. However, it seems to me that with this complex of a process, there is going to be some wrinkles as you ramp up in making a new manufactured product, right?
Yeah, we've talked about this multiple times just in the last couple of months when we talk about the PDC and metrology equipment companies like KLA Corp, the leader in metrology. Whenever you have a new manufacturing process, especially one as complicated as this one that TSMC is trying to use to make these Blackwell systems for NVIDIA, as you ramp up production, it is actually just normal. Contrary to what that media report claimed, it's just normal to find things that need fixed. This is a manufacturing process of epic proportions, and you're going to find issues with yield, issues with the process that need fixing. You might even find some design flaws in there. It happens. This is a brand new thing. That's why NVIDIA has always said they will be ramping up production the second half of 2024. Calendar year 2025 is when Blackwell revenue will really start to make an impact on NVIDIA's financials. Again, I don't see how this is new data and new information from the information and from some other outlets as well, trying to get into the nitty gritty of all of this. Reminds me a little bit of one of my favorite GIFs of John C. Reilly. At any rate, I digress here. Our process, and I think the process for most investors should really center not around media reports or secondhand information or thirdhand information. You should base your investment decisions on what the businesses tell you and the results and the data that they present you, not from speculation or some rampant sensational headline based on information that you can't find anywhere else. That's just how I feel about it. And I guess I feel pretty strongly about it, huh? Sorry.
It does make sense. We don't claim to have all the answers, but we do take our cues from what the companies say and what the data shows, as you mentioned, Nick. And what the data says is that NVIDIA has made a ton of money in the last year on these data center accelerated compute chips. and they still plan on making a lot of money, hitting their stride with revenue generation. And once again, looking at our chart on market segmentation and where we are in the cycle, what NVIDIA plays in is everything on the right, but they are especially focused on this AI infrastructure, cloud and enterprise accelerated compute. And both of those segments are experiencing growth.
Yeah. And of course, NVIDIA's, I guess we could call it a legacy segment, PC, graphics, video games. It's a lot more than that. I think we're going to have a follow-up video to this shortly, explaining how NVIDIA is already moving on from the data center, but is already planning for the next wave of accelerated compute infrastructure build out. And these are fast moving businesses. Everybody knows this now. AI inference. When you have the big boom in technology in the data center, in the cloud, you need to have a step up in technology at the edge as well. That could be your PC or laptop at home or at work, or it could be manufacturing equipment, some sort of industry specific equipment operating at the network edge. It spans all industries now. So we're starting to see that trickle down effect from the initial wave of data center accelerated compute build out into the rest of the semiconductor industry. That hasn't really changed. This is still the data that we've been presented. We've had a wave of earnings the last few weeks that have just confirmed that. I don't know. Kasey, there's a lot of questions now. What do I do as an investor with a big sell-off? Maybe some investors are underwater on some newer positions that they've taken. Or maybe if you're a new investor, you're just flat out underwater. Have we changed in our messaging here on how to approach investing in volatile infrastructure-based tech?
No, our messaging hasn't changed at all. We still have a lot of conviction in this company, NVIDIA, and believe what they're saying regarding their revenue stream, their outlook for the rest of the year and into 2025. And so if you're a new investor, something like what you see on the screen may make the most sense, a DCA plan or dollar cost averaging plan. And this isn't a specific chart. This is for reference only, just so everyone understands that. If you have a dollar cost averaging plan, you buy whatever the stock price, and eventually that averages out and you really realize those gains over time. And so right now, when NVIDIA has had this major pullback, it may be a good time to average out your price of the stock.
This kind of brings us full circle again. If you were willing to buy on the way up, maybe at peak prices, 52-week highs, nothing's really changed other than a lot of media outlets, some hedge fund managers, some real big investors getting on these media channels and stirring the pot. Nothing's really changed except for that. If you're willing to buy on the way up, why wouldn't you still be willing to buy now on the way down when the stock is now cheaper? This makes no sense, but this is an investing 101 concept. So many fail to grasp. In tandem with this too, Kasey, two other points that I think we need to drill down on here before we wrap up this video that we preach all the time. In addition to being patient and averaging into a position on a business gradually over time, that's how we did it with NVIDIA. We've owned NVIDIA stock for a long time and just kept nibbling over the course of years. You're not going to be a hero and like dump a massive chunk of your portfolio all in one go on a business that you probably don't understand that well and just become a millionaire in the course of a year. Doesn't work like that. So in addition to taking it slow and buying in batches, including when it hurts to do so, we don't own just semiconductor stocks. You still need to be diversified. You need to own other businesses that aren't cyclical and that don't exhibit extreme volatility. And you need to learn to develop your own process, your own framework for investing your portfolio. If you want to invest in individual stocks, it doesn't matter if you're a trader or if you're a long-term investor, you need to develop a framework. If you were basing your decisions off of secondhand information, third-hand information from the media, from hedge fund managers and from Wall Street, talking about, the popping of the AI bubble and all of this stupid nonsense, you're going to lose this game. I'm sorry, but you're going to lose. They're going to take your money from you. You need to develop a process that focuses on firsthand data points, firsthand information, first and foremost. We hope that we can help you narrow in on that with some of these leading businesses like Nvidia and the Magnificent Seven, and so on and so forth. All the other companies that we cover here tends to be tech focused, but it's not always tech focused. Learn to rely on the data those businesses give you, not sensationalist information from companies like The Information.
I want to remind everyone that we have a membership on our YouTube here or over on our Ko-fi page. It's called Semiconductor Insider. That gets you access to our Discord channel where you can have up-to-date information from us, exclusive content, all of our video notes, and published manuals are available to you for just $5 a month. Make sure you check that out in the link below as well. And we will have much more coming your way. As Nick mentioned, we'll have a video follow-up on Nvidia. And then we're also going to be talking about Qualcomm very soon. So make sure you hit the subscribe button, and we'll see you all very soon at Chipstock Investor.